Good afternoon. This is Larry Tentarelli with today's edition of Your Daily 5 for StockCharts.com. We'll get started with a brief introduction. My name is Larry Tentarelli. You can find me on Twitter. My call handle is @LMT978. You can also find me on my website. I'm the founder of BlueChipDaily.com. We have a 30-day free trial. If you're interested in what you hear today, you can join us for free to see a little bit more. So we'll get started with today's Daily 5. And I was on a few weeks ago, and what I'm going to do is touch base and follow up on a few charts that we spoke about a few weeks ago, and then I've got a new chart to take a look at. So we're going to start with the core markets, and we're going to start with the S&P 500. So the last time that I was on, SPY was trading right around 386. So today it's trading at 372. And my view here still with the indices, with the S&P 500 and with the NASDAQ 100 is for my time frame, they're still in a primary downtrend. So I've got primarily a 3 to 6 month or longer time frame. I'm a position trader. I'm a trend follower, and what I look to do is I dial out past the day-to-day activity, and I look for the bigger trends. So for the S&P 500 right now, just like it was the last time, the trend for me is still down. So we've got a series of lower highs, we have a series of lower lows, all four moving averages. So I've got the 20-day, 50-day, 100, and 200-day. All four are declining. All four have crossed through each other. And for me, this is just a very, very strong and steady downtrend. So it has not been able to close over the 50-day moving average. If we take a look going back to the middle of April, there was a rally just below, another one just below, and then another one recently failed at 390. So the key levels on my screen, and as I said, I don't focus too much on day by day, tick by tick. What I'm looking for is the big trend to participate in the bigger move. So key levels on my screen, 365 is a recent support level, tested just below that, but 365 is a key downside support level. 390 was where it failed at recently, and then 400. So the big numbers for me is if the S&P, if SPY could close over 400, then for me, that would negate a lot of this downtrend, and that would tell me that there could be some type of a longer term base building attempt in process. But the issue right now is that it's nowhere near close. The rallies have failed. We've gotten a sharp drawdown, failed at the 50-day, sharp drawdown, failed at the 50-day, starting to weaken here. This gap below 375 is concerning, down 1.7% on the day. And I've got to say, I don't have any positions in SPY, but I am short triple Q. We'll take a look at that in a few minutes, and we'll take a look at another short position that I've got. And I take positions both directions. So I've got some long positions right now. I've got some short positions right now, but the way that the S&P 500 is set up, this is a very, very bearish chart for my time frame, and it's in a pretty steep downtrend. So we'll take a look at chart number 2, triple Q. Now I do have a position in here, but we'll start with the recap. So the last time we looked at triple Q, it was 292. And triple Q failed exactly at the declining 50-day moving average. So once again, this is the same structure for the most part as the S&P, lower highs, lower lows, declining moving averages. So the key levels on my screen near term, 275 and 300. So if triple Q for some reason could start to close above 300, then that would tell me that maybe it's trying to build some type of a longer term base, and then 315 would be a key level. If for some reason it loses 275, then that opens up the chart to the downside. So once again, this is a downtrend for my time frame. I do have a long position in PSQ, which is the 1x inverse of triple Q. And I've got some concerns besides these charts. I have some concerns overall with the markets, and the biggest concerns, obviously, the Fed is on a very, very aggressive tightening path. When the Fed is tightening, especially as aggressively as they are right now, that's generally not good for risk assets when they're taking liquidity out of the system. Now, there's some conversation in the media, have growth stocks bottomed? Can growth stocks perform better in a recession? And my experience is that in a recession, most stocks don't do very well. So it's based on how much the economy slows. But for right now, this triple Q chart is in a downtrend for my time frame. And the first sign, I would need to see a close over 300 just to give that chart some hope. So we'll go to chart number 3. So I do have a position here. The last time I was on, we took a look at crude oil, and I had a somewhat negative view on crude oil, and that's continued to follow through. So ERY is the 2x inverse ETF for the energy sector stocks. So not for crude oil specifically, but this is the 2x inverse of XLE. Chevron, Exxon are the two biggest holdings. But what we see in this, and this is a recent position for us over the last 2 weeks, so this is working out very nicely. But what I see here is the opposite of what we just looked at. So we've got a series right now, higher lows, a series of higher highs. If the 20-day is rising, the 50-day is flattening out, the 20-day crossed the 50-day to the upside, and then the 20-day is in the process. It actually did cross the 100-day. So for intermediate term momentum, very constructive here as crude oil is rolling over, XLE is rolling over, and with this ETF, and I was in XLE in the energy sector for a while, but with this ETF, if crude oil continues to roll over, which I think right now it's trading around 93 or $94 a barrel, and if XLE continues to roll over, which it made a lower low today, then I think that there's a lot of potential upside in this ETF. So this is a recent position for us. It's been working out up about 10 points or so from the first buy. So we'll see if that can follow through. But this trend overall is set up well. Chart number 3, XBI. We took a look at this the last time. It was trading around 77. Right now, trading around 80. So I will say that I do not have a position in XBI right now, and it's still under the 200-day moving average. But the healthcare sector, which is biotech and large cap pharmaceuticals, the healthcare sector is the only one of 11 S&P sectors that I have on our current buy list. Biotech is a part of that. And what I'm seeing with biotech, it looks like it may have put in a significant low. A lot of volume came in here, had a nice recovery move, pulled back, held over the recent low, and then it had a very big move on a lot of volume. So if we take a look at this chart, very similar to ERY, starting to trend higher. The 20-day is rising, bullish 20, 50-day cross, 50-day flattening out, trying to turn up. And then recently it had a first close over the 100-day, going back to November of last year. It's starting to hold in this price base. We'll call this over 78 and then over 70. So near term, XBI does look like it's trying to break out into possibly a stage 2 uptrend. It's got a lot of volume coming in. And one key thing is the healthcare sector. Of the 11 S&P sectors, the healthcare sector may be the furthest removed from the entire inflation conversation, the inverted yield curve, Fed rate hikes. Healthcare might be the furthest removed. Reason being is healthcare is somewhat more defensive. If people get sick, if they need healthcare or they need medication, whatever it is, whatever's happening in the yield curve doesn't matter if somebody has to go to the hospital or if somebody needs medication. So energy, cyclicals, industrials, even large cap tech and financials are very, very sensitive to what's happening in the yield curve and the economy. But healthcare is somewhat outside of that picture. So XBI, as far as the growth oriented charts, this is one of the top ranked charts. It's a recovery chart. It could be somewhat more volatile, but that continues to work higher. And then we'll take a look at chart number 5. So chart number 5 is one of my favorite longer term ideas right now. I've got a position and I started to build a position in TLT over the last few weeks. And if it starts to move higher, then I'm going to add to that position. But TLT is very simply the ETF for 20-year US Treasury bonds. And what the thought process is here is as the Fed continues to hike, right now they're pricing in a 100 basis point rate hike at the end of the month. And whether it's 100 or 75, the Fed is on a very aggressive rate hiking path. But what's happened is the Fed is hiking into a slower economy. And generally what that tends to do is as they continue to hike, it tends to slow down the economy. Long dated bond yields tend to perform well. So TLT trying to test over the 50-day here, 20-day starting to turn up. This has been in a pretty pronounced downtrend. It had a pretty high volume down day here, pretty high volume down day here, and then it's trying to trend higher. So this is a recovery idea chart. If it starts to test over 118 to 120, I'm going to look to add to that. This could be very volatile, but as long as it holds over these recent lows at 108, I think there's a considerable amount of upside potential. So that's it for today's video. I hope that you enjoyed the charts and have a great day.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.